You don't have to listen long to hear a lot of negativity about life insurance, but today we're going to talk about life insurance celebrities.
You are listening to Wealth Talks with the McPhees. There are life insurance celebrities out there, and it's in multiple different ways. Some of them are famous because they have been involved in the insurance business. Others are famous because they didn't plan so well. Others maybe they did leave a big legacy. So we're going to talk about some of these people today and the lessons that can be learned. We're also going to talk about the current environment. There's talk about the estate tax exemption, the lifetime gift tax exemption being rolled back. There's also talk about the step-up in basis being rolled back, or maybe even the annual the annual exclusion amount for the gift taxes.
All of those things, if they happen, is just going to make a better market for life insurance, because life insurance protects, up to a certain degree, many of those things that are now law, which if they go away, life insurance will be the only way that people can protect themselves.
Yes, and life insurance has been grandfathered in for decades as there's been changes in the tax code. And so it's one of the more solid and sustainable ways to pass a legacy on. And if the changes go through that they're discussing the tax code, then it's going to be even more so.
Well, let's start with going back to the Trump administration and saying that the Trump administration's new tax law did away with the step-up basis for IRAs and 401k accounts, and forced people to liquidate those accounts within 10 years of inheriting them, rather than being able to extend that income over their entire lifetime and even out the tax liability.
Yeah, so it got rid of the generational wealth aspect of those type of accounts.
And so savvy planners and estate planners and CPAs encouraged people to buy life insurance with those 401k funds while they were still working and living prior to taking their Social Security distributions, because it saved them so much in taxes and gave a huge bonus to those heirs, because there was a much larger death benefit than what was even in the 401k or the IRA account.
It makes
great
sense.
Planning.
Sure.
So the way the wealthy continue to stay wealthy and the way the poor continue to get poor is because there's no planning. So often we hear people, well, I don't really care about the death benefit. What you're saying is you don't really care about the future. You like the way that the rich keep getting richer and the poor keep getting poorer. That's what they're saying when they say that.
Yeah.
They don't know it, but that's what they're saying.
That's an interesting way to put it.
Now, from the Trump administration to the Biden administration, Biden, like you said, is thinking about getting rid of the gift tax allowance. Mm-hmm. He's thinking about rolling back the $15,000 that one person can give to another without having any complications
the
in
annual
a year.
exclusion.
The annual exclusion. He's talking about getting rid of the step-up basis that someone gets when they inherit an estate, so that only the growth while they own it is taxable, instead of being taxed on when someone bought it that gave it to them.
Mm-hmm. Yeah, so here, a real quick example. If you're not familiar with the step-up in basis, let's say that we have Joe, who is the dad, and let's say we have, Tammy, who's the daughter in this situation. Let's say that Joe bought stock for $10,000 50 years ago, and he dies, and the stock is now worth $100,000. Well, Tammy inherits that money, and let's say she keeps those stocks for another 20 years, and maybe it goes up to $120,000. Now, because of the step-up in basis, then when she goes to sell that stock, if she sells it at $120,000, then she only pays taxes, income taxes, or capital gains, or whatever it is, on the $20,000 of growth since she owned it.
Yes.
Now, if the step-up in basis went away, then that would mean that she would pay on everything on $120,000 minus the original $10,000 of cost basis. A huge difference in taxes.
It's a huge difference. Or let's say that Joe owns a small business that he started just from sweat equity, has put hardly anything into it financially, so he doesn't have a record of how much the business cost.
Okay.
And so really this business just started out of thin air, and
Okay.
his
Or
imagination.
his services, sure.
And now he passes and he leaves that business to Tammy, who can't run it because she's not licensed
Okay.
to run it. And so she's forced to sell it. Or maybe she just doesn't have the expertise to run that business. So now she's forced to sell it. She's going to pay taxes on every bit of profit that comes from that because there's not going to be any step-up basis. Whereas with the step-up basis, when she inherited it, that's what the business was worth. She could have sold it and paid no taxes.
Interesting. So now you know what step-up basis means. Obviously, if that goes away, that would greatly increase taxes.
And so what life insurance can do is before Joe died, he could actually donate his business to a charity. They could sell the business and pay no taxes. He would get a deduction on his taxes for giving a large gift to charity. And with the difference, he could buy a life insurance policy whose death benefit would go tax-free to Tammy.
There we go.
And this is the way
So there are
tax
some
planners,
options around this.
There's lots of different plans. So what Biden is doing, he's going to drive the sale of life insurance.
Interesting.
And the rich always find a way around the rules. It's the poor class and the middle class that don't understand this or have never been exposed to it to see a way to get around some of the tax ramifications. But like we said in an earlier blog, this administration says America is going to suffer because of our policies. Mm-hmm. They're on record saying that, and that's disturbing. So we need to be, like Jesus said, as wise as serpents and innocent as doves. We need to be really shrewd when we're dealing with the tax code, unless you appreciate and enjoy all the things that Biden is spending money on.
Yeah.
And then you're welcome to pay as many taxes as you want to.
Yeah. I don't think a lot of people have agreed for a long time about what government spends money on, regardless of the administration.
So, there's a lot of people that understand life insurance, and today we're going to talk about the celebrities like Tom Clancy and Vicky Gunvalson. And all these people, they understood life insurance. They own it. They sold it. It's very fascinating. The people, Evel Knievel, was the legendary bike maniac that jumped the
So is he the
Ring.
guy that would run these motorcycles all over the place and do all sorts of stunts?
Tried to jump the Snake Canyon and so many boxcars. He was a very, very amazing motorcyclist. But he sold life insurance and was very successful at it. In fact, he worked for W. Clement Stone, who owned a life insurance company,
Fascinating.
and said that it was W. Clement Stone's book that helped him get through one of his crashes. Otherwise, he probably wouldn't have survived, but it gave him the mental fortitude to do that. So we can go from Hollywood stars to famous athletes like Tommy Maddox of the Pittsburgh Steelers and Dennis Havig and Emmett Johnson, Lincoln Kennedy. All of these people have been involved in the life insurance industry because they understood it. And for those of you rock and rollers, Jim Simmons of Kiss is now an insurance executive helping people establish long-term estate planning, just like we've been talking today.
Fascinating.
And for any of you, those who think you want to solve a family feud, then just turn to Steve Harvey, who was a very successful life insurance salesman, but he said he just didn't like the follow-up.
I think that's a lot of life insurance agents today. They don't like the follow-up, and that's why the service is probably pretty bad in the life insurance industry, is because there isn't a lot of incentive for service, and that's something that we try to change here at Life Benefits, is to always provide top-notch service to clients.
Well, on a commissions based compensation, there's not a lot of incentive to provide service because you get paid when the sale is taking place. We wanted to make a difference in the life insurance industry, and that's why we are so service-oriented, because too many people buy life insurance and then forget why they bought it, and so they stop making the payments, and then they lose money. And that's one of the reasons life insurance has gotten such a bad name over the years, is that people have not serviced it. And when our clients buy life insurance, they keep it. because they're using it, they understand it. And part of that is our service, part of it's our education, and part of it is our passion to let people keep more of the money they're making, and because that's what we use the life insurance policies for.
Now, the type of life insurance is important too. We've talked about this on previous shows, but obviously people don't keep term insurance forever because the term eventually runs out.
It does.
And even the universal life insurance, they usually don't keep that because the premiums get too expensive at some point.
That's true. In fact,
Even though they thought it was permanent, it ends up not.
That's right. In New York Life, the financial services division of New York, not New York Life, New York State, they have warned the public to stay away from universal life products because of what you just said. The ever-increasing cost of that insurance and that policy doesn't make it as permanent as it sounds to begin with.
Yeah. So when we're talking about permanent life insurance here, the kind that stays around that people keep for a long time, we're talking about participating whole life insurance.
And usually that participating whole life insurance policy has been overfunded so that there is equity developed in it. The whole life insurance is the only type of life insurance sold that allows the consumer, the policy holder, to actually have equity in the policy. All the rest are like renting. You never own it. You're only leasing it.
That's a good point.
So John Wanamaker, way back in the day, in the 1890s, was the most insured person in America. In fact, as the New York Times headline blared, Wanamaker, the most heavily insured man in America, the prince of shopkeepers, carries nearly $2 million on his life. And that was a ton of money back in 1894.
Yeah. So $2 million back in 1984. What would that be today?
That'd be about 54 million.
Okay.
Lots of insurance.
A little bit of perspective.
Yes. And so when they asked him why, John, are you carrying so much insurance? He said, number one, because for one small monthly premium, I'm able to provide millions for my heirs. So that was his first person. He wanted to bless the next generation.
Okay.
And those that don't want to, they
don't care about the future.
They
like
don't
you
care
said
about
earlier.
the future. Number two, with every payment he made to the insurance, he became more and more invested in the company that shared their profits with him. Most people don't realize that the equity that you develop in life insurance pays you dividends when the company's profitable. Dividends are a great thing because they build up tax-free. Okay? It's like getting a paycheck that is not taxed. Number three, the equity in his life insurance was quick and easy money for him to access for all of his growing enterprises, which he was very entrepreneurial. He's the father of shopkeepers. He was the first department store owner. He was the first person to ever offer benefits to employees. He was the first person ever to say, this is the price you paid, this is the price you can return it for. He was the first person ever to put price tags on his merchandise in stores. Everything else up until that time, people came in and dickered for what the price was. So he was a very brilliant man. When he took over the YMCA, in less than 2 years, he more than quadrupled the membership because he was so passionate about what the YMCA was doing for young Christian men.
Fascinating.
Fourth, he was able to spend all that he made while he was living and still leave a legacy because his goal was to spend his money to create a better economy for himself and for everybody else in his community. So money being hoarded doesn't allow for economic development. It's only money that can be accessed. And so he understood that. And those four principles are still viable for participating in life insurance that has been purchased with overfunding, like we talked about.
Yeah, it's a great way for people to build liquidity with a small monthly premium, to invest in the company that shares profits with you through the dividends, the life insurance companies. And that equity you can use to finance other opportunities and even expenses in your life. And you're able to leave a legacy to those that you love while you're able to maximize what you're able to spend and the benefits that you're able to create during your own lifetime. Those four things, they absolutely hold true today.
Well, we only live once. And when we die, the question is, what are you going to leave? Proverbs 13:22 says, "A good person leaves an inheritance not only to his children, but to his children's children." And life insurance, participating in life insurance specifically, is one of the ways that we can fulfill that proverb.
That's a great point. You're listening to Wealth Talks with the McPhees. You can give us a call at Life Benefits, 702-660-7000, and we can help you make sure that you're able to leave a legacy to those that you care about, because you also care about their future. Have a great week, and we'll be back next week.